Good morning. Welcome to Trading Hour. It's a brand new week. It's Monday, 11 a.m. I'm Reema Tendulkar with Mia Pavitra Parekh and Surbhi Upadhyay as always. And it's a break below 17,000 today. So the Nifty's breached that 17,000 handle, down 150 points on the Nifty. The Sensex lower by 500 points. That intraday will show you the low today was sub 16,900. That happened sometime around 10:30. After that, markets are trying to climb back higher from the day's low. We've managed to recover close to about 60 points, but it's still bleeding red across most of the indices. The mid-cap index is down over 1.25%. That's not seeing any sort of a recovery. The advanced decline ratio is currently at one stock in the green for 3 in the red, and there is panic and worry across the rest of the Asian markets as well. Pull up something like the Hang Seng, and that's down nearly 2.5%. So despite many efforts by global central banks to contain the contagion and the risks associated with the global banks, the sentiment is still very, very fragile in the market, and clearly you can see a fair amount of risk off. Sectorally, it's the global facing banks which are taking the hardest knock. The Nifty Metal Index down 2%, the PSU Banking Index down 1.5%, and IT too. The Nifty IT Index is now down 1.3%, and that's turned year to date negative with the fall that we've seen. And that's the kind of fall that we've seen over the last 10 days since the beginning of that SVB crisis. The Nifty was above 17,500, and now we are below that 17,000 handle, almost 16,900. Hi, girls.
Hi, ladies. Well, we start with more of the same, right? Don't we, as we get into Monday today. But I think the saving grace or the little ray of hope that I'm trying to hold on to is this minor recovery on the banks, the Bank Nifty and the PSU Banking Index, as you pointed out. Bank Nifty is now down about 0.6%, slightly better, a shade better than the Nifty. But the overall market is still holding on to those losses of about 150. We were down 180 points at one point in time around 10 o'clock, just an hour back. So from then, can you call it a mild recovery? Don't know, not sure as yet. Pull up some of the Asian markets. I mean, the picture's pretty somber out there. The Hong Kong market's down 2.5%. You have the Nikkei looking at losses, similar kind of losses, 1 to 2%. Shanghai is mildly negative. So it's still uncertainty that's playing out. And I guess the big question for the market is, does it end here with this UBS buyout? Or is there more? Yeah. And I think the market's leaning on the more side because the one piece is this whole write down of additional tier 1 bonds, $17 billion. As markets and investors adjust to that, are they going to be shaking out other positions to make good those losses? And then, of course, we have a long week ahead with so much happening in the US. Yeah. Who knows? First Republic Bank, is Warren Buffett getting in? What will the Fed do? I think it's just going to be a big roller coaster this week, Pavitra.
Yeah, many questions, right, as far as the global markets really go. So, I mean, we are watching for that, but it is that kind of market, right, where a 30-point recovery is what we're holding on to. I mean, that's the way the market is shaping up right now. The metals pack, like we've been pointing out, is where we're seeing the maximum pain come through. Once again, sharp cuts. Reema was going through some of the larger ones, but take a look at some of the smaller, metal names. Something like a Nalco is down almost 4%. You have JSPL, NMDC, just a few on your screen, but take a look at how those are working. The banks, while there has been a recovery in some of them are still seeing sharp cuts. So RBL is down 5% right now. Your Bank of Maharashtra down 4%. Mid-cap IT, once again, not looking good. So, some of the larger names will be down there. For the Adani group of stocks, everything other than Adani Green seeing sharp cuts today. So, take a look at that. And the only pack which is really holding up, with some kind of decisive gain is perhaps what's going on the back of crude prices. So, over there, you'll have some moves seen in BPCL, HPCL, IOC, ONGC. These are some where you can, if you're really looking for green in the market, perhaps look at that. But let's talk about the markets. We have Anil Sareen, CIO of Centrum PMS, joining us to discuss the way forward. Anil, thanks a lot for joining us. This is Pavitra. Like we were pointing out, this is the way the market is looking in spite of global banks really pushing, injecting this kind of liquidity. Do you think the way things are positioned right now, there's a scope for it to get much worse from here? Or do you think we're going to be range bound at around these levels for a while?
No, I guess, we will get some indication tonight when the FOMC meeting happens. And obviously there is maximum kind of pressure. There is seldom a single cockroach, etc. All those things come to mind. But one thing it's worth thinking about is that, unless the rates come down, the pressure on US banks is not going to go away. And it's such a difficult decision. On the one side, you have inflation. On the other, you have a full-on kind of a run on the banks. And that run won't go away till you reduce the rate. So tonight's events will have to be watched very, very carefully.
Anil, globally, even if we just continue to see maybe one more rate hike and then a pause, and we don't see a rate cut, do things get a lot worse? What you are asking is that markets right now need a pivot from the Fed and they need rate cuts to bring down the broader collapse of the US banking system. If that doesn't play out, at best, we continue to see these rates, but for longer, maybe the whole of this calendar year. Then what is the impact on the markets? How bad do things get?
So, Rima, let me explain my reasoning regarding the rate cut and not about continuously going up through the year. I'm in favor of a cut because, it's one thing to say we will make the depositors whole. It is one thing to say that you can sell your bond, MBS, whatever it is that you have to us at face value, etc. But that doesn't take care of the basic problem. These banks are offering very low rates, whereas depositors have an option to go Treasury Direct, they have an option to go to money market mutual funds and get much, much higher returns. So as long as that differential exists, no amount of assurance, no amount of backstopping is going to help. So right now, the Fed is in the horns of a dilemma, which is the greater evil. And obviously, to your point, Rima, if it continues to increase through the course of the year, then obviously markets will see a much worse situation than what we are seeing today.
Anil, hi, good morning. So I think we just have to wait and watch these events play out, right? But in the meantime, if people want to focus on their portfolios and start nibbling in because the opportunity presents itself now, how do you advise they should go about it? What would you be buying? I mean, if you do have a shopping list ready.
It has been ready. We are mostly committed. So now we just have to grit our teeth and sort of, go through this turbulence. The fact remains that Indian companies are offering selectively very, very attractive kind of earnings growth. And also we keep hearing from various commentators, various leaders, how India is such a favorable destination across the world. So it's a question of going through, managing this volatility and remaining committed through this period. At the other end of this is, very, very good earnings, very good kind of outlook for the Indian stock markets. The earnings are going to be there. When the sentiment changes, it will translate into stock market gains. So we have to keep the faith. There is every reason and very sound logic for keeping the faith.
Any preferred sectors, again, just to go back to that question, for those who want to build medium-term portfolios, any preferred sectors that you'd want to highlight?
Sure. So infrastructure is one area where there is kind of visibility. Real estate also has a lot of strength. Healthcare, quite independent of everything else, is doing well. Hotels. Select technology stocks, not to be confused with IT services company, but technology-oriented digital business model kind of company. These are focused on the Indian market. So there are pockets where you should consider nibbling even under this bad market condition.
Anil, we have you on a really scratchy line, so our team is trying to fix that, but I request you to please stay on. We're just going to try to patch that connection and come back to you in... All right, let's wait and see. Maybe the team can try to repatch that connection, and we'd love to continue that conversation. In the meantime, let's quickly take a break. We'll come back and we'll talk more on the markets. Welcome back. You're still tuned into Trading Hour here on CNBC-TV18. For the market, it's a 160-point cut that we are seeing. The banks have recovered a tad, but it is still looking like an extremely deep cut. 0.8% gone on the Nifty Bank. We were having a chat with Anil Sareen on the markets and which way we could really move from here. Anil, you were mentioning the sectors that you like. You said infrastructure is one space which could be good. Healthcare. Is there anything else that you would look at? And is there anything that you're completely avoiding? Are the global-facing names a complete no right now?
No, I think, So to add to the list, infra, construction, real estate, healthcare, hotels is another area where there is good scope. And then these recently listed digital business model companies, where the price correction has been quite a lot. And now the numbers, the operational numbers are starting to look quite good. So these are the areas where you would be, finding good outcomes if you accumulate patiently. As to avoiding, I think, yeah, I mean, global-facing IT services amongst the large caps. I mean, maybe you can expect some kind of price correction, given that earnings are not going to grow as much as the valuations are probably suggesting.
Amongst these digitally facing companies, there are so many, right? There is a Nykaa, there is Paytm, PB Fintech. Which ones would you prefer?
Yeah, so the leading ones, I mean, there have been others which have sort of they didn't even open very strong, and after that, for over the period of time, they have sort of kept on going down. But yeah, you have mentioned some of those, especially in the financial sector. There are those numbers which are appearing to be pretty strong, and there is a dominant position. Or whether you can look at the food delivery companies, I mean, it's a duopoly, and it's very, very difficult to sort of break in for a third player to come in now. So yeah, I mean, patience should be rewarded over here. Obviously, you will have to watch the operation, the operating numbers very carefully. But as far as their market dominance is concerned, there is no doubt.
Okay, that is on the new age companies where, you know, perhaps they've corrected enough for it to be a comfortable position to enter. Anil, how would you look at the banks now? Because a lot of these have also corrected significantly, right? They're offered, right? Would you look at those? And within banks, then what do you like?
No, so the issue with banks is probably they are overowned. Certain names which are sort of turning around and all, they seem to be overowned. And one more thing, I mean, regarding banks, people say, look, they are trading at a price to book multiple lower than what they used to trade at maybe 4 or 5 years ago. But to that, one has to also add the kind of reality or focus on the new reality that their book value growth or their advances growth in the recent 3-4 years has not been as strong as it used to be 4 or 5 years ago, when they used to trade at much higher price to book multiples. I'm talking about, let's say, HDFC Bank or some of those well-known names. So I think now we have to watch. They are well priced. Some of them probably are overowned. Otherwise, there is no issue. I mean, I'm not in the camp that says, oh, because the US banks are suffering, you should just sell your Indian banks. That kind of transmission mechanism is not apparent to me. So there is a case to be holding these well-performing, high-quality banks.
Any sectors where you anticipate big declines in the stock prices? Which someone could look at exiting right now at current levels?
No, so there is this confusion. I mean, those industries which probably benefited from COVID-related disruptions, and there they probably enjoyed temporary, supernormal profits. So it could be in the field of chemicals, it could be in the field of diagnostics, etc. That correction phase is ongoing, and there could be, weakness even after the price correction. There could be further weakness ahead. So one would want to wait and watch. Otherwise, the overall rubric of China +1 remains in play. But yeah, those excess profits, as they sort of reduce as time goes by, the price correction is already ongoing, and it could persist for some more time. So investors would be advised to sort of take a more careful stance over there.
All right, Anil, that's been very useful, but we're going to leave the chat at that today. Thank you very much for joining us with your take on the market and all of these individual pockets as well. With that, let's move on and talk about what's going on in the commodity space, because Manisha is with us, and today she's going to tell us about something that's actually benefiting from all of this turmoil that we've seen in the global market.
Oh, well, absolutely. And that is gold, where we are looking at an all-time highs in the Indian markets today. And not just India, gold is trading at an all-time highs in India, in Australia, and UK as well. And in the US markets, we are trading at an 11-month highs here. We did see gold prices go all the way to 1995 on the higher side, so not too far away from that 2000 mark. But the Indian markets clearly trading at all-time highs right now, where we have seen prices go to a 59,500 above kind of levels, so not too far away from that 60,000 levels there. Well, the run-up has come in on the fact of of the weakness in US dollar index, and we also are looking at the banking concerns that continues to support the prices. If you look at the gold prices itself, we are up by nearly 5.5% in the previous week, and with that addition, it nearly is 7.5% of gains coming in for the gold prices for the month of March as well. Well, what the markets are looking at is the bank term funding program, which is expected to add $2 trillion of liquidity in the international markets. That clearly has been supportive for overall metals and more so for gold and silver there. Also, the weakness in US dollar, the recent bank contagion is what is bothering the markets. The US Fed policy on 22nd of March, the markets are anticipating that either you're looking at 25 basis point of a rate hike, and the probability of that is nearly 80%. That seems to be comforting the gold bulls as well. And not just the US Fed, you have various global central banks meetings coming in for this week. For example, you have Bank of England, Swiss National Bank and Norges Bank. That is the monetary policy meetings this week. Apart from that, you also have the inflation data coming in, and that's coming in from Japan, UK and Canada. You also have PMI numbers coming in this week, and that also comes in from US, Japan, UK, Eurozone, Germany, France, all of those countries. You also are looking at the silver prices trading at a 10-month highs. So whether you look at precious metals, it's gold, silver, platinum, almost everything is trading in the positive there. I also want to tell you on what we've done in sense of range when you look at the gold prices. Last year, we did see 2,052 of a high. This year, we did see a low of 1,810. And from those kind of lows, we've seen nearly $200 of a jump up. On a month-on-month basis, when you look at the report card for gold for this year, January started quite strong. Feb gave up all those gains, and March has regained all of that and much more. So not too far away from $2,000 for the international markets.
Okay, Manisha, thank you very much for that. Getting very, very expensive there. Slip into a break. On the other side, we'll be joined by the management of Technocraft Industries to discuss their business. Welcome back. Let's get a corporate conversation going then. Now, Technocraft Industries is the stock and the company on our radar. It hit a 52-week high last week. So amidst all the turmoil, Technocraft Industry was actually gaining. And it's seen a decent up move so far this year. The numbers are also looking good. In the last 9 months of FY23, revenues have gone up by 11%, while profits are up 13%. We're now joined by Sharat Saraf, the CMD of Technocraft Industries, on the show now. Thank you very much, sir, for joining in. Could you give us an indication how Q4 has been? What are you likely to end the year FY23 with? And any outlook for the next year, FY24?
Thank you, ma'am. The last 9 months were a little challenging because of the Ukraine-Russia war, and we lost some business from Europe. Therefore, our results probably could have been much better than what they are. But anyway, we managed to scrape through, even though our top line in the consolidated results was a little bit lower for the comparable period of last year. We managed to do better in terms of bottom line this year. Ma'am, this as far as the future outlook is concerned, I think the Europe and US still continue to be in a recessionary condition, and the times are a little bit difficult. But at the same time, we have taken several steps to mitigate this situation by changing some product mix, as well as doing some cost-saving activities in our organization. We are also doing some capex, new capex of about 400 crores, which should be over in our next 12 months' time, so that our top line by 31st March 24 could look healthier by another 500-600 crores. So overall, I see good possibility for our business, except for textiles, which continue to be a challenging area. And there we are applying our mind to see how we can re-engineer it and bring it back to the profitable level. Maybe the situation of textiles is also likely to improve.
Mr. Saraf, you came right to the point that I was thinking of. I mean, the share has done exceedingly well, very close to lifetime highs in a market that's so volatile. I think the market is quite happy with the way your precision engineering business is doing. The problem is textiles, and there's been a lot of chatter about you looking at perhaps hiving off that part of the business, some sort of a demerger, business restructuring that perhaps is on the table. Can you clarify on that? What are you planning to do with textiles? And what percentage of your revenue is textiles right now?
Yes, the revenue is about, I would think about 30%. Between 25 to 30% is textiles. But it is a difficult business at the moment. And we are thinking of restructuring, something like demerger, making it into a different separate company so that we could have a closer watch on its accountability. And we are also investing some more money into Amravati, which is a very profitable sector at the moment, while our unit in Murad, the textile unit in Murad is what is bleeding. So we are trying to do some restructuring there. And I think situation will be more clear in another 3 to 4 months' time.
Okay, the other part of the business that I want to ask you about is the scaffolding segment that you have, because I believe a big part of the revenues here, 70 to 75%, is from the export market. So can you tell us what's going on there? And I think after Q3, you had also mentioned that the drum closure business saw pressure on margins because of, elevated costs. You said that you expect that to come down, in the near term. Has that happened?
Yes. So let's take one at a time. As far as scaffolding is concerned, we've had a great year, and we had record-breaking sales in US, and which I'm very hopeful of continuing the same surge even for the rest of the year as well, and for maybe even the next year. So looking at this bright possibility, we are putting up a new greenfield plant in Aurangabad for formwork, particularly aluminium formwork, which is the new trend now. So when that comes up, our scaffolding business will really grow very well. And as far as concerned, you are quite right. There is a pressure on the profitability. So we are adding some new products, additional products, which will happen in next 2-3 months' time. And we have also strengthened our marketing, make it little more aggressive and sharp, so that we get a better result. So I think we will not let our profitability of drum closures down. It will probably look better next year.
When do you think, sir, you will move on demerging the textile business? Is this something on the anvil in the next board meeting?
That can happen. We are evaluating it at the moment. We are evaluating.
But do you think you will be able to conclude it this calendar year? Or is this more, say, 2 to 3 years?
It looks, calendar year looks difficult, but in the long term, yes, it can happen.
Mr. Saraf, just a word on
it can happen.
In a year, okay, so you're looking at a demerger in a year. And it's 25 to 30% of your revenue right now. Just a word on the balance sheet. Is there any debt on the books? If yes, if as you go through the demerger, will you be moving part debt to the textile entity?
The only debt we have is what was required for our subsidies and for the backward area benefits and so on. Otherwise, there is no serious debt in the company.
Okay, just a word on the margin as well, X of textiles, because now the market will start focusing on your precision engineering business in a bigger way. So X of textiles, what do you think the margin profile can be over the next 1 year or so?
For drum closures, we can expect the margin to be around anywhere between 25 to 30%. And for scaffolding also, we can expect margin of 20 to 25%. This is on a conservative side. We hope to do better than that.
Okay. All right, Mr. Saraf. I think the market's going to watch out for those plans and the execution very, very carefully, particularly, as you said, next 3-4 months will be critical as you look at options of demerging the textile business. Thank you for giving us all the details today. We'll take a quick break on that note. More on the markets on the other side. Welcome back. The pressure is still very evident on the screen, still 1% down on the Nifty. Though the saving grace is that, for what it's worth, it's managed to get its head back above 16,900. Let's take it to our market expert then, and then get some ideas in terms of the trading strategies now. Ashish Kyal of Wave Strategy Advisors is with us. Ashish, thanks for joining in. Tough market. How are you negotiating it, and what are the trades now?
Hi, morning to you and all the viewers. Yes, the market, we can clearly see, had a gap down today. It's sustaining there. There is still no attempt to fill the gap. So this is not a sign of positivity, okay? There is a sign of concern that we can see. On the downside, one green shoot is that there is some kind of a support around 16,850, 16,880 from where it bounced back from there. So if 16,850 remain protected, then we can see some attempt towards that 17,000 mark. But crossing that is not going to be easy because we are started seeing some sharp rise in the call open interest side. So it's going to be a very interesting scenario. If 16,880 and 16,850 breaks, then the another round of selling will start. So from here, stock specific action can continue, but index wise, keep a close watch on that 16,850 levels or that 17,000. Let's see where it starts to break out from here on. As far as specific stock is concerned, I'm going to be bullish on Dr. Reddy. After some time, it is showing some positive attempt on the upside. We can see that the trend for the stock has reversed after it formed a low around 4350 levels and bounced back sharply from there over past few days. And long positions can be created here, keeping the stop loss of around 4320 for the target of 4790. The next stock on the buy side is going to be Indian Oil Corporation. We can clearly see IOC has outperformed in the market given the cool off that we are seeing in the oil prices also. And this stock can start another round of upside move from here on. So long positions can be created in IOC, maintaining a stop loss of around 77.20 for the target of 86 levels.
What a move these oil marketing companies have seen over the last couple of days as crude prices have seen a big tumble, the lowest levels that we've seen in the last 15 months. IOC, BPCL, these stocks have seen a phenomenal rally. Pull up, say, a 10-day or a 2-week chart of BPCL, and you would see, a smart move. This month itself, BPCL is up close to about 12 to 13%, and analysts are expecting the Q4 earnings to be bumper for names like BPCL. A month-to-date chart, or this month, in the month of March, we've seen a 12.5% rally for names like BPCL. But let's talk about another big story. Okay, in moments from now, we will be getting you more information on why the Tata Consumer Bisleri deal has been called off. But for that, we'll just wait for some time. The Nifty once again is gravitating towards the 16,900 mark. At 11 a.m., the markets were attempting a bit of a rebound. It improved from levels of 16,900 to 16,950. But once again, that rebound has been sold into, and the Nifty is inching towards 16,900. So it's not looking good. Bounces are not sustaining at all, even very minor ones. But let's get back to that big consumer story that we were talking about. Why has Tata Consumer called off its talks with Bisleri over a potential acquisition? Mangalam is here with more information from what he's learned from his sources. Mangalam.
Well, that's correct. We were just looking at Tata Consumer and Bisleri's announcement on Friday itself, the fact that the negotiations have ended. So at the same time, I was trying to find out some of the reasons. While valuation would have seemed an obvious parameter, but we understand from some of the sources in the company and ones who were working on the deal that there was a lot of delay in these negotiations. They were going on for over 8 months, and as a result of which there was some disagreement over the deal structure as well. So those were some of the factors. A lot of the data points as well were the lack of access to that were some of the factors that would have led to the deal actually falling through. Valuations, while they were on the higher side, were definitely not the main concern. And remember, Tata Consumer's beverage portfolio anyway over the last few years has been growing twice the Bisleri's growth rate. In fact, Narishco reported 44% growth CAGR between FY20 and FY23, whereas Bisleri grew about 20% between FY20 and FY15 itself. The other parts of the Tata Consumer business, which is Tata Copper Plus, which is their value-added water, was growing at a CAGR of over 100%. Their premium segment, which is actually, as a market growing 2 times the normal segment, has a market share lead of 3:1 as against Bislery's Vedika. So Bisleri would have, Tata Consumer would have grown to Bislery's size in a few years organically anyway. But what the deal would have given them is immediate access to the market and infrastructure. Bisleri had about 120 operational plants, a distribution network of 6,000 plus touch points at the same time, 7,500 trucks too. But now Tata's will go ahead and build their business organically for the beverage business. So that's what we've found out from our sources.
All right, Mangalam, thanks a lot for bringing us all of the details. That is Tata Consumer dropping the Bisleri deal and it really falling through on the deal structure. But with that, we do need to get into a short break now. On the other side, we're going to focus on a whole lot of individual stocks that are in focus on the back of news flow. So stay with us. Hey guys, welcome back. You're still tuned into Trading Hour. Let's talk about some individual stocks which are in focus today on the back of news flow. Adani Enterprises is the top loser on the Nifty today. It's down almost 4% in trade after a report by PTI suggests that the company has suspended work on 34,900 crore petrochemical project in Mundra. So Vivek is here with the details. Vivek, take us through the highlights of this report that have come through.
Well, absolutely right. It's again curtailment as far as capex is concerned. They're being a lot more prudent in terms of how exactly growth is going to come in. And when you're talking about what exactly the PTI report indicates, the company, according to PTI, has suspended work on a 34,900 crore petrochemical project in Mundra in Gujarat. Now the company, on the back of that, has also gone ahead and suspended plans to raise close to 14,000 crore of funds, and that was meant for this particular project. So we understand that, to vendors, etc., they have said that at this point of time they're suspecting and they will indicate, if and when they restart this particular project. Now, one thing to remember, Adani Enterprises had incorporated a subsidiary named Mundra Petrochemical, and this was a complete, greenfield coal to PVC plant capex that the company had actually earmarked. Now, we reached out to the Adani Group. The spokesperson indicated that at this point of time, Adani Enterprises will be evaluating status of growth projects in the primary industrial vertical, over the coming months. So again, curtailment of capex, something that the market at this point of time not really liking.
Thank you very much for that. But some of the other Adani Group stocks, like I think Adani Green was holding up in the green just some time back. But let's talk about HDFC Limited and HDFC Bank. They're in focus as the NCLT has approved the merger of the housing finance arm into the bank. Abhishek is here with the details. Abhishek.
Well, as you mentioned, NCLT over the weekend we got to know that has approved the merger of HDFC Bank and HDFC Limited. The exchanges had already approved of the transaction of amalgamation. The deal will be the biggest transaction in India's corporate history. We also need to see integrity. Some of the details that they have sought with regulators, like stake in HDFC Life, can they take it above 51% post the merger, and other some key points that they have taken with regulators. So that addressal needs to be done. We earlier had the management of HDFC Limited, which was confident of this entire amalgamation or the merger process going through by Q1 FY24, that is either by June or July of 2023. Back to you.
Okay, got that, Abhishek. Thanks very much for the details. We will take a quick break. On the other side, all the big global headlines coming up.
Hey guys, welcome back. Let's talk about the big global story now. UBS is set to buy out embattled rival Credit Suisse for around $3.2 billion in a deal backed by a massive Swiss guarantee. The takeover is expected to close by the end of this year itself. So let's listen in to what Chairman of UBS had to say on this transaction.
I would like to make it clear that while we did not initiate discussions, we believe that this transaction is financially attractive for UBS shareholders, protects UBS from additional downside, and should support earnings growth over time. The terms of the transaction have the full support of the relevant regulators and secures financial stability for all our stakeholders.
Okay, so this current global banking turmoil has raised a lot of questions on what it means for the Indian IT companies, the tech service providers like the Infosys, TCSs of the world. Remember, the BFSI, which is the banking, financial services and the insurance vertical, is the largest vertical for the Indian IT services in terms of revenue. The exposure plate will come up for you, and it ranges from anywhere between around 30% for Infosys and TCS, and it goes up to well over 50% for names like Mphasis. So these are the companies most exposed to the BFSI, the banking, financial services, and the insurance vertical. So amidst renewed worry about a global banking crisis, what's the impact on the growth for IT companies? CLSA has laid out some scenarios. They're saying there are two scenarios. The first one is that we see a contained crisis with quick interventions by central bank. This will impact the decision-making of the BFSI vertical in the near term, but the impact on other verticals will be minimal. The scenario two is that it plays out over a longer term. It's a larger, more elongated crisis, and this affects not just decision-making, but it will affect the revenue growth of the BFSI vertical for 2 to 3 quarters, which means the current Q4 quarter and Q1 and Q2 of next year, and it will also impact other verticals like retail and telecom. And they're saying that this happened even in the GFC crisis. There is a third scenario, according to CLSA, in which a large, systemically important global bank fails. It sparks a wider credit crisis, prolonged global recession, but they're seeing a minimal probability of such a scenario playing out, and hence they've ignored it for now, and they're not talking about the possible impact. But CLSA believes that while there will be some pressure on the top line, margins are likely to stay resilient in both the scenarios, at least for the larger companies, as we had seen previously in F509 and F510, because there will be a calibration of annual wage hikes and promotions next year. JP Morgan has also written on this. They're saying the collapse of the SVB Signature Bank and concerns about liquidity across EU and US can further soften tech spends by banks over the short term, going up to 1 year, with slowing growth in bank tech budgets. They also say that this will impact the IT companies in two ways. One, there will be a delay in deal ramp-ups, which affects revenue conversions over the next 1 to 2 years. Two, there will be delays in deal closures, and this will play out over the next 3 to 4 quarters. JP Morgan goes on to say that they estimate the US regional banks' exposure is highest at Infi and TCS, but it's still less than about 2 to 3% of the overall revenues. Bulk of the revenues comes in from the larger financials. They estimate the SVB exposure at 10 to 20 basis points for Infi, TCS, and LTI Mindtree, but it may lead to provisions. Companies may need to make some provisions in the current quarter. They also go on to say that this has driven a correction. It's taken multiple down, but estimates right now do not factor in increased EPS risk from any further slowdown in spending. Indian IT companies have outperformed on a year-to-date basis by nearly 6% because the Q3 earnings season was not as bad as people had feared. But now with the macro uncertainty rising, all eyes will be on the Q4 earnings, and that will provide the full picture of the possible impact of this global banking turmoil on the Indian IT space. Today as well, the Nifty IT index is now down 1.5%, so underperforming the benchmark indices. Well, with that, it's a wrap on Trading Hour from the entire team. Thank you for watching. Stay tuned. Halftime report is up next.